Welcome to Subramani. Many people have been asking how to do research in stocks. So I'm going to the very basics. So please subscribe, please hit the bell icon. This may be either one video, very unlikely that it is one video, it will be 2-3 videos, and then I will combine them and make one longish video, or both combinations will be available. So the question is how to research stocks. So first of all, stocks, shares are called stocks in the US. So I will use these words interchangeably. Mostly in India we say shares, we don't say stocks, but in literature that we read, which is largely American, we say stocks. So I'm using them interchangeably. So stocks or shares form an important part of most growth portfolios, right? So somebody like me would be 90% in equity almost always. Sometimes I could go down to 88, sometimes I would go to 105 if I have a leverage position, but that both are very, very rare, because my total investment in bonds and SGBs and gold, etc. Remains constant. So the percentage can keep shrinking. So having said that, since stocks form an important part of your portfolio and many of us are tempted to buy and sell shares or create an investment portfolio and not go to a mutual fund, we should know how to buy shares, and or rather how to research shares, right? So how do you do? I mean, if you want to be a good photographer, what do? You go and look at good photographs done by good professionals, see what exposure they use, and you copy, right? Shamelessly you copy. If you want to be a good batsman, I'm part of an academy where I see a lot of people preparing. They watch videos of good batsmen for very long periods of time. There is no shame in copying. So you should copy how to do investment research, but I'm not saying you should copy and say, oh, this is what Buffett did, so I will do that. But there are things to learn from Buffett, there are things to learn from many of the big investors, many of the good investors, something to unlearn also. So you go and copy, right? So typically what does a professional do? What does a professional do as a research thing? There could be quantitative, there could be qualitative research which they do. So you could copy them and you could learn from them. When I say copy, I mean learn from them. You could do just speculation. You could buy in the morning, sell in the afternoon. Very good chance that after some time you lose so much money that you will not be in a position to do it again. You would have wiped out your net worth. So there are two types of strategies which people use. One is the fundamental analysis. In fundamental analysis, you go about looking at the PE of the company, the EPS of a company, how well the numbers, first of all the numbers, saying this is the earning per share, this is the return on capital employed, this is the return on net worth, this is the return on assets, right? So today return on assets may not matter much because the best companies don't have much of assets, right? Google doesn't have too much of assets. You don't look at ROA for a company which is intellectually dependent. So whereas for a cement manufacturer, two cement manufacturers, when you are comparing, you will see what is the return on assets for one versus the return on assets for the other one. So understanding which ratios to calculate, which ratios to use for which industry, all that is part of your fundamental analysis. And then saying, oh, this much of value should be there, it is not being captured, is saying, oh, now I am a value investor because I think the value of this share should be 200 but it is available at 130, or vice versa, or the reverse, where you think the value of the share should be 130, or 130 is the price at which you are willing to buy, now it is 200, therefore you will not buy. So value investing, growth investing, momentum investing, some portion of your portfolio could be growth, some portfolio could be momentum, saying, oh, this industry is in favor, so let me buy some of this, or saying, oh, this industry is in favor, it has gone up too much, so let me now not buy. So all those things are part of your fundamental analysis, which is largely called the quantitative approach to the calculations and all that, and also a qualitative approach, because after doing all this, you are also going to see how good is the management, how good is the, first of all you will choose the industry in which to look at, which is called top down, and then you will come down and say, okay, therefore this company and then you will do I mean top down you will choose the industry. Suppose top down you have chosen cement industry, then bottom up you will choose say Prism Johnson, saying I like this company and out of the market cap this company is so important, I will look at Ultratech, I will look at maybe India Cement, right? So 3-4 companies, and then I will decide doing a bottom up whether these companies are worth investing, which means I will now do a proper research into those companies, do all their calculations and then see the quality of management, and then I will decide to invest in that company. So this is what is called fundamental analysis. The quantitative approach, which like I said, the quantitative approach uses all the financial data and the matrices and the valuation formula, and the qualitative approach is more about the context and less tangible measurement, quality of management, the macro cycle, right? So all those things, they work best when they're applied together. The quantitative analysis is technically demanding since they involve some element of arithmetic. This is not too much of mathematics. There is no derivatives and integration that you have to do, so don't worry. Professionals have to study this for some time before. Yeah, don't think by watching this video you are going to become a great analyst, but you at least know the process of what people do, what professionals do as an analysis. So what are the things that they calculate? First is the price earning ratio, right? You know what is price earning ratio, or you can search for it. I am not making this video too long. Then you also look at the price earning to growth. Companies price earning is 20%, which you think is very high, or it is 30%, which is very high, but it is also growing at 30%. So when the price earning to growth, the ratio is 1, it means all the price earning is justified by the growth that the company is giving. So this company which is growing at 30% will have a PE of at least 30%, because you arrive at another ratio called PE to growth. There's another model for older companies where you say, okay, there is this dividend discount model. Every year this company gives 7 rupees as dividend. Now it is available at a price of 120. It is not too bad. I'm getting a 5.5% dividend yield, plus there could be appreciation at the end of it. So that is the dividend discount model, saying in 4 years, 5 years, 6 years, I'm going to receive the whole price that I pay. If I paid 35 rupees for this share, then I'm getting a 20% dividend yield, which means in 5 years I recover the cost of this share. So some shares like this are available, especially at the bottom of the market cycle, not at the top of a market cycle, but it could be available. Then seeing how much money has this company borrowed, how much is the debt equity ratio. This cuts both ways. Companies, when you see the borrowing, you say, oh my god, the borrowing is too high, but then you realize that if they want growth, they will have to borrow, because once the company does well and it is earning well, then it can repay the loan, right? So why would you dilute equity? Anyway you need money, so either you take it as equity or as debt. Since you have a good earning, you have good margins, you have got good visibility of revenue, bankers are willing to lend you money, or you are willing to raise money in the market, you are using all that to increase debt, and you are happy with that amount of debt. So if the company's got debt but it is repaying at a good pace, that is okay. But otherwise, if you compare two companies with similar margins, etc., then you would prefer a company with lesser debt. How do you know this? By calculating the debt equity ratio, right? So you do all this. This is your quantitative this is the quantitative analysis part of your fundamental analysis, right? Qualitative tactics are little more abstract. They analyze the quality of management, the effectiveness of what they said and what they did. Last year they said, 4 years back they said they are going to do something in defense, they have not yet done it, right? So all those things come into it, and then you look at the board of directors, you look at the auditor, you look at how diversified they are, you look at have they reduced risk by having plants in 2-3 different geographies, right? You look at all that, you say, oh, it's power intensive, and the place where they don't have much power, they have a problem. So are they now tapping solar power, are they tapping other forms of power? You look at all that. So that is I mean, that's part of the qualitative thing. How much of market share do they have? Is their market share increasing? Are new, younger, better competitors coming? Is foreign competition a possibility? Are they able to sell their products abroad? So that once you know that they can sell their products abroad, then you're less worried about foreign market is coming and dumping their products here. So all that is part of a qualitative analysis. So after you have done the quantitative analysis, you also do a qualitative analysis. Say, look, all these numbers look good, but I don't trust the management. That's a good red flag for you to look at and say, I will not look at this company anymore, right? So having said this, now I will have to go to technical analysis, and I think technical analysis we'll do in a separate video. That will be part 2 of how to do equity research and buy shares. Thank you.